What's up everybody and welcome back to my channel. So I'm very excited for today because starting with this right moment, I'm going to be doing a 10 episode marathon on personal finance during the month of April. This means there will be 3 videos per week about 5 minutes long describing the most captivating things happening in personal finance, at least in my opinion. The videos will go live every Saturday, Monday and Wednesday, so if you want to learn more about personal finance, then please don't forget to subscribe. And with that being said, let's commence with the first video. In the first video, I'm going through the 3 simple concepts to achieve financial freedom. And these concepts are disposable income, time versus money, opportunity cost, and compound interest. Starting with the first one, which is disposable income, this is a concept that is crucial to achieve financial freedom and to understand exactly what you have in your pocket at the end of the day. And that is because the disposable income is the amount of earnings that are left in your pocket after you subtract all the taxes and all the other associated costs like accommodation, transportation, meals, and anything else that is considered as basic costs. So what do I mean by this is actually understanding the concept of how much money or how much are you valued after you pay for the basic costs for your existence, and not look at your salary figure as an indicator of what is your final income. So to look at a basic scenario, if you're single and you live in New York and you earn $100,000 per year, according to this year's tax filing season, you will be owing 31% of your income taxes. Which means that from that $100,000 that you earn, you are being left with $68,000 after you pay all your taxes. Then you need to subtract also the cost for the accommodation, and if we take a basic scenario of $2,000 per month for a 1-bedroom apartment in New York, then you are being left with paying $24,000 per year on only your accommodation costs. Then you also subtract the costs for transportation, which probably will be around $1,000 to $2,000 per year. Add your utility bills and your meal plans and some other minor costs that are necessary for your minimal existence, and this would probably cut around $5,000 to even $10,000 per year, which brings it to around $32,000 left in your pocket. Only with understanding this concept of disposable income, you will be able to not overspend and have a proper budget for your monthly spendings, and maybe set up some goals for this year for savings or investing. The second concept is about time versus money opportunity cost, and this is a big one. If you want to achieve financial freedom, then you definitely need to relate your time to money and stop wasting time on things that don't bring any value. What does the opportunity cost mean is basically doing something over the alternative things, and what brings you more cost advantage, then that's the right thing to do. So if we take a specific scenario, even in my case, sometimes I have not too much time to edit the videos on YouTube, and I also have other projects on the side. Usually those projects, they bring in more value and more income, at least at this right moment. So I do understand there is an opportunity cost if I do something else and not concentrate on my main tasks. Which is why sometimes I need to hire an editor, because paying someone a smaller amount and focusing on my bigger projects will end up bringing more value for me personally and will save me lots of time. The final concept that I want to talk about is compound interest. So the compound interest could also work for you and against you. Let's start with the against you part, which means that if you have, for example, a student loan to pay back, then you will have the compound interest that is working against you, and that means that you basically have to pay interest on interest. But first, what does compound interest mean? Like I just mentioned, compound interest is the interest that is added to your initial sum of money by week, month, or year. So to make this thing work for you, it means investing in something and keeping it long term. Say a simple scenario, if you invest $300 at the start of this year, and you have a 10% return per year, then you will have $330 at the end of this year. If you then decide to keep this investment going, then next year, given that you have 10% return again, then you will have this 10% applied on your initial sum of money, which is $300, plus the $30 that were made in interest for the previous year. So this second year, your final interest is going to be 10% out of 330, which means that it's going to be 33. And of course, if you scale this thing up and you add more zeros to your account, this thing is going to grow and be more significant to you. And one day you might achieve some passive income that is surpassing your active incomes. And to wrap up this video, please don't forget to subscribe and like the video. If you did like the video, leave your comments below and let me know what you want to see in the next episode of this personal finance marathon. See you next time.